Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. What we're going to talk about today are the proper use of limit orders. We actually had a coaching call recently where we got into the discussion about limit orders versus market orders versus stop market orders, stop limit orders, buy stop, a stop loss. It sounds like a lot, but it's really not once you wrap your head around the most basic concept, which is a limit order. And I think that there's some initial confusion by newer traders that come into the market about the ways that are possible to use a limit order. So we're going to actually break it down. We actually have a spreadsheet where we're going to show different prices. But I think the biggest revelation that you're going to get across today is that, in my experience, based on what I've spoken to quite a few traders over the years, is that most traders mistakenly use market orders all the time. And just to give you some context on that, myself as a professional trader, I rarely use market orders at all. And it really comes down to two things. Number one is anticipating when you want to get into the trade as opposed to reacting late. Oh, it's running and I need to get in now, so I'll just mark it in so I make sure I don't miss the trade, which, by the way, can get you really horrible fills and you don't realize that. I'll get into that in a second. And the second part is liquidity. It's very common, again, and I think unfortunately too common, where newer traders coming into the market don't understand fully the liquidity of the stock that they're trading and how that affects getting in and getting out of a trade. So, for example, I could give you a real world example. Somebody recently was trading a stock that they had a profit in the stock, but went to sell the stock, and the stock did not have a lot of liquidity. And I'll explain what liquidity means in a second. And what was a profitable trade based on the quotes turned into an unprofitable trade because when they marketed out of the stock, it actually knocked the stock down. And there was one bid here and the next bid was way down here. So there was advertisements, I'll just use round numbers, advertisements to buy at 20, and the next advertisement to buy outside of the best bidder offer, I'll get into that in a second as well, was 50 cents lower. So when the 20s disappeared, and that's the price they believed that they were going to get, because they used a market order and the liquidity was not good, they got actually filled 50 cents lower. And what was a profitable trade turned into a losing trade. So I guess first we're going to talk about what's known as the inside market or the best bid offer, which is what most people look at. So let's say you're looking at a stock and you see the stock has a quote of, and I'll just use made up numbers, $20 by 2001. And that's the actual way to say it. So 20 by 2001, $20 is the bid price. That's what people are advertising to buy. And the offer price, sometimes known as the ask, would be 2001. And that is the limit order that people are advertising to sell. So that's known as the inside market. Now, what happens is when most inexperienced traders begin in the market, they're more reactionary. They're more, I just need to get in, I need to get out. As we get into the program, as we get into the boot camp and they start to watch the training, you understand that the type of order is generally going to be used based on the urgency to get into the trade, which you get better and have less urgency as you understand tape reading, because now you're anticipating, now you know the prices well beforehand. You know the difference between placing a limit order versus placing a stop order, which we're going to cover in a second. And you also know how to use price improvement, which I think that's going to be the biggest thing that we're going to talk about today. And I'm actually watching myself in this video. I look like a doctor. I don't know what's going on with the shirt. So we're going to head on over to the screen and we're going to take a look at why I rarely ever use a market order and how you right now, provided that you're trading stocks that have liquidity. And liquidity, I'll explain exactly what that means in a second. Provided you're trading stocks with liquidity, you can take advantage of price improvement like that and never need a market order. No, I shouldn't say never. Hardly ever have the need for a market order if you're on top of your game and you understand how to anticipate and understand how to read the tape. So essentially what I'm going to teach you right now is the proper use of limit orders, as well as how to use a limit order where you can buy up here using a limit order and get filled at a better price all the way down here. And that's actually, what's the word? I want to use the right word. it's a law. Basically, it's basically a trading law where you have to get price improved at a better price if there's shares available. So if you place a market order, excuse me, I have to sneeze. This is real time. If you place a market order, you can get filled at any price. And there's a lot of smart routing now where they'll go out and search for an order. But if you place a market order, you're putting it in their hands. And I think that that's something that a lot of Robinhood traders don't understand. And that's actually one of the things that they just got fined for. They got fined $65 million because they did not disclose that they're routing your orders away. But when you place limit orders, you can't get worse than that price that you place, including when you place a stop limit order, especially in stocks that are liquid. So I'm going to explain what that means. But the whole point I want to get across here is hopefully I'm going to wake you up to the fact that you shouldn't be using market orders all the time. And just as importantly, if you want to get into a trade right now and it starts to move on you a little bit, generally speaking, I use an order where I'll try and buy on the limit to get my price. But if I can't get my price, then I'll place an order a little bit higher than the current offer price, the current ask price. And generally speaking, I can get filled at a better price, get into the trade, but not get a worse price than that. So I'm willing to pay up a little bit. That's the worst price I'm willing to get. But if normal circumstances are there, I'll actually get a better price. I'm going to explain what that means right now. This can save you thousands and thousands of dollars. I want to be clear about that. So anyway, so this is basically what we're talking about right now with a market. So we're going to keep it very clear. So remember what I said before, this would be the best advertised buy order, right? So somebody's advertising a limit order to buy at 50.24. Somebody else is advertising to buy, to sell at 50.26. So very simple, right? 50.24 by 50.26. And that's known as a 2-cent spread. So when you have a 2-cent spread, there's prices that can happen in the middle, but for the most part, you're going to be buying here or selling here, right? However, you can also buy here. So this is one of the most confusing things for newer traders is using a limit order. I can try and buy here, but if somebody is not selling to me, and you'll see the selling in time and sales, right? This is a time and sales window. You'll see red selling, in this case, 50.25 or 50.24, right? So in this case, it's actually 50.24. 24 and red prints note on the tape is when there are trades going off lower than the previous price. So that's why they would be red. So if I'm trying to buy here at 50.24, but nobody is selling it to me, so there's no trades at 50.24, 50.24, we don't see that, then I have to make the decision. I want to try and buy it at 50.26. So these people on this side on the ask, again, sometimes known as the offer, they are also trying to get into a trade either as a sell short or get out of a trade because they're trying to sell the position. If I can't get filled here because nobody's willing to sell it, I could then make a choice to buy the shares available here. And just for argument's sake, you can see there's 5,000 shares at every price, at 26, at 27, at 28, at 29. And that's important for what I'm going to show you next. But let's say for argument's sake, this trade starts to light up where a lot of people are buying at 26, then 27s are starting to buy. And you can see in time and sales, there's a lot of active buying going on, right? So what do? I can try and place a limit order here to buy. So again, I just want to take a step back. You could buy on the limit, hoping somebody sells it to you. You could buy on the ask by taking somebody else's shares. But if it's moving quickly, you might not get the fill. So you have 26 as your best limit order, right? 50.26, but if it's moving quickly, you might not get it because those 5,000 shares could go quickly, right? But what if you said, I am willing to place an order above 50.26, not get worse than that price, but if there's shares available, you can get price improved. And here's what I mean by that. And this is what we're talking about, the magic of limit orders, provided that you're trading stocks that have liquidity. And you'll be able to see that in whatever trading platform that you have. And most liquid stocks, again, I trade stocks that have an average of 2 million shares per day traded. They generally have stock at every level. Excuse me. So let's just say, for argument's sake, I'm willing to pay 5 cents higher than the current offer, but no worse than that. So that means that I would go to my execution system. I'd place a buy limit order at 531. I can't, excuse me, 5031. I can't get worse than 5031. But, and here's the key, if there's shares available at a better price, in this case, 5030, 29, 28, 27, maybe even some at 26. If I place the order here, and let's say it's 500 shares, just for argument's sake, I can't get worse than 51, but I could get 5026 still because there's shares available in between. I could get 5027. I could get 5028, but I can't get worse than that. So this is a technique very commonly used by professional traders where, and somebody in our community asked this last night, where this is the worst price I'll get. I'll pay up, and the conversation came up in hotkeys. So you have a hotkey that will buy on the bid or place an order to buy on the bid, or another key that will be buy on the bid +5 or buy on the offer +5 as a limit order. So the value in this is that you will almost always get your trade executed at a reasonable price that you are willing to pay up to, but no worse than that price. Now, the downside is if the stock is moving faster or it doesn't have the liquidity, you might miss the execution. So you need to be aware of when and how to use this. But like I said, the better you understand order flow, the better you understand how to read the tape, you start to anticipate when you're getting into trades. And that makes it easier to get the fill. So I just want to go over this one more time and kind of wrap it up, right? You could advertise to buy on the bid as a limit order. You could remove somebody else's shares who is advertising to sell also with a limit order. But if the stock is moving fast, and again, you'll see that it's moving fast in time and sales because there's a lot of green prints that are paying higher prices. If the stock is moving fast, you can choose to go higher than the limit offer. So in this case here, 5026 is the best offer. You can go to 5031, again, 5 cents, for example, place a limit order at 5031. You'll get 5031 or better, provided that there are shares there. Now, the next question is about a stop limit order or a stop market order. We're going to keep this video about limit orders. So let's say, for argument's sake, the price is at 5024 by 5026. But for whatever reason, you say, when that thing gets up to 5033, I want to place a buy order. That's when you would place a stop buy limit order or buy stop limit order. So you would say, okay, I'm going to execute this right now. I'm going to put this trade in the market. I'm going to place a buy stop at 5033. So the stop, in this case, the stop means it gets up to that price. That's when the order triggers. And the limit order is the limit order. That's the worst price you can get. So let's just keep it simple and keep the stop and the limit order at the same price, which in this case would be 5033. So if the price is down here, but you want to get in, let's say a chart pattern or a breakout is up at 5033, you place your buy stop limit order so that when it gets up to that price, you don't even have to do anything. It takes you out of it, puts you into the trade, or at least the order goes out to the market, again, provided there's liquidity. Now, what's interesting about this is that some people are like, oh, wow, that's confusing. But you're already doing this on the other side of the market, because a stop order means when it gets to that price, execute or put the trade into the market, right? This is a stop loss order. You're already doing it. You say, okay, when it gets down to 5018, take me out of the trade. And that's what a stop order is. Generally, you can use a stop limit or a stop market order for the same thing on the other side. But what we're doing here is we're using the stop limit order, a buy stop limit order, to get us into a position, again, anticipating getting into the trade. So this is a kind of big deal, and not big deal because I'm teaching it, big deal because it's something you want to know, because when you understand placing orders correctly, you place limit orders at the right price that you say, I want to get in at this price or better. If a stock starts to move on you, you can try and take somebody else's limit order with your limit order. And if it starts to move a little bit faster than you anticipated, you can use that buy stop limit order above the market. You'll get price improvement if there's shares. You could even just place it immediately, a limit order above this. Now, I want to make it clear, though, the ending part of this. A buy stop order, and the stop part is the key. A buy stop order doesn't trigger until it gets up there. A buy limit order triggers immediately. So you have to make sure you add that stop part into the equation when you place your order, when you actually get into your platform, or otherwise your order is going to get filled immediately. It won't wait till it gets up there. It will get filled as soon as you place the order. So I think that if this is new to you, Watch it one more time, and I believe that it'll be very, very simple. Now, if you're like me, like when I first started, I actually had to write this stuff out. It's pretty simple. It's really pretty simple, and it really comes down to using limit orders are ways to not put yourself at the mercy of the market and get any fill. You're in control of the price that you get. The only downside, and it's a small one, if you're trading stocks that are liquid, meaning 5,000 or however many shares at every price, the only downside is if it moves super fast, you might not get the fill, and then you have to place another order because you have that price or better. But the better you get at anticipating, the better you get at reading the tape, the more focused you are on your watch list, the easier it is to know what you need to do before you need to do it. And that's really when you start to elevate as a somebody who really knows what they're doing. So anyway, I definitely watch this video more than one time if it's something new to you. It's absolutely something you want to know, and I'm going to tell you why. This will be the last thing we're going to cover right now. This can save you thousands and thousands and thousands of dollars a year just understanding the difference between a limit order and a market order and how to use it. It's that important. Have a great day, everybody. I'll speak to you soon.